Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have Marcos Viriato, co-founder and CEO of Parfin, as well as John Matheson, managing director, Asset Token Ventures. We're here to discuss TradFi's demand for digital asset infrastructure and why the financial industry is undergoing its largest technological shift since electronic trading. Gentlemen, it is great to have the both of you with us. Welcome to Trade Talks. Marcus, let's kick it off with you. Give us a background on Parfin, where you sit within the financial ecosystem.
Hi, everyone. Hi, Joe. Hi, John. Thanks for being here. So I work in financial market TradFi for more than 25 years. Majority of it was a bank, BTG Pactual in Latin America, covering technology and operations. A few years ago, I left the bank and decided to start Parfin with the views that there was a lack of technology, blockchain technology infrastructure to allow banks and financial institutions to tokenize assets, to deal with digital assets, and so on. That's where we started. The journey has been really good, and now I think the market's maturing and it's converging to what we're building. So we're very happy to be here again.
All right, you got it. And John, tell us about ATV.
Absolutely. Hi, Jill. Great to be here. Well, Asset Token Ventures, or ATV, we have founded a yield coin fund. And so what that means is we're backed by mortgage-backed securities. Everyone's familiar with mortgage-backed securities backed by the U.S. government through Fannie, Freddie, or Ginnie Mae. And so it's similar to a treasury, similar treasury risk profile, yet a greater return. And these days, that's anywhere from 85 to 125 bips or so. So every 1% is a lot for people chasing a yield. So the other piece of it, though, is I'm based in the United States Virgin Islands, and that's not just because it's a great island paradise, but it's because we have certain tax incentives here. And those tax incentives we've qualified for, through the U.S. Virgin Islands governmental agency. The top tax bracket for our fund is 2.31%. So that beats anything back in the States. And so compounded over time, of course, that's a great return for our investors too, when you combine those two things for a fixed income product, but with a better tax efficiency.
Yeah. Marcus, let's talk about this demand for digital asset infrastructure, particularly with the TradFi sector. It seems as if it's being pulled forward more as the space starts to mature. Why do you think you're starting to see that demand for the integration?
I think, first of all, I think there's more clarity under the new administration. Again, a lot of the kind of prohibited regulatory framework now is down. So banks are feeling more comfortable. Even, we've seen, banks talking about crypto, which was completely forbidden a few months ago. But the whole proof of concept and testing of the tokenized assets, starting with money market funds and high yield debt instruments, we're already under proof of concept. And now I think it's getting a very good momentum. One example, we've done a work with JP Morgan Kinexys last quarter, or the last quarter of last year, where we tokenized funds, but we embedded a primitive of privacy for all the transactions within the blockchain to be completely private between the parties. And that's, again, a requirement that we will see more and more coming. So, and again, that brings a lot of efficiency to the markets by distributing funds globally. And I think this is something that we're looking more and more. A lot of asset managers and banks, moving to provide this infrastructure for their clients.
Yeah, especially, with the accountability and traceability aspects of it. I think, John, that's why you're seeing this shift to real world asset tokenization. I mean, the addressable market for that is quite large, to your point.
Huge. No, it's huge. I think some estimates has already been 2 billion fixed income products put on chain already. Some studies out there say by 2030, 10% of the GDP, can be tokenized. I mean, that's like 68 trillion. Obviously, it's been very, publicized what some of the large investment firms are talking about. Anywhere from BlackRock with their own BIDL product for U.S. Treasuries has done very well. But, all the big firms, from Goldman to Citi, JP Morgan, Fidelity, they've all put out their statements on digital assets and tokenization. So I think, once you have the right product, everything shouldn't be tokenized. And there's some stuff out there that really should not be tokenized. But if it's a real product and it really changes the democracy, as they say, to allow investors to participate in some of these products where before they could not.
Yeah, and I'm glad that you brought that up because, MBS kind of brings back some of those memories from the financial crisis, but it sounds as if the way that the product is being packaged now, that the governance has improved.
Correct, absolutely. Of course, back in 08, 09, those typically weren't the Fannie, Freddie, Ginnie
Right.
products that had the implicit backing of the U.S. government. But even the others, obviously, that's been pretty much addressed in the process. But even beyond, MBS, what was a surprise to us is we've had a number of fund managers come to us and say, hey, can you put our product in the U.S. Virgin Islands? You have the structure, you have the tax incentives, and so we're already well down the path with a couple groups where private credit will be tokenized. One's a green energy firm, and another is in the film and moving industry.
That's
So
interesting.
it just makes perfect sense to allow that.
Yeah. Marcus, I want to go back to governance for a moment here. We know blockchain solutions, they do promote transparency and accountability within the structure of it. But in traditional finance, that transparency, it has been governed. How or, TradFi and DeFi, how are they grappling with that to make sure that the right governance is in place to satisfy the needs for privacy, but then, also be able to perform those fiduciary functions?
Yeah, I think this is again is something that doesn't, in our view, combine with the usage of public blockchains, and we've seen the surge of some like let's call, I wouldn't call permission, but blockchains of a specific purpose. Again, JP Morgan Connexus is a good example where there's been a kind of a on-chain repo facility for U.S. Treasuries repo, gaining a lot of efficiency on the post-trade process. And then they create the JP Morgan payment infrastructure, which is a must-have. So we will see more and more, I would say, those specific purpose blockchain networks where you're going to be able to enforce, like, for instance, KYC or suitability, where clients will not be able to buy a certain tokenized product if they're not suitable for under the various jurisdictions regulatory framework. And again, the work we've done with JP Morgan was on-chain suitability checks, so the client wouldn't be able to buy a certain product if they're not eligible to. And I think this we will see more and more. Obviously, it's very difficult to enforce this in some of the public blockchains because you don't have controls. So that's why I think this next move of the TradFi on-chain will require some elements of KYC, suitability, and even kind of audit or regulatory review, where if required under a judge's approval, the transaction will need to be open, because again, you see in some countries, if there's a court order, you need to open the data, right? And I think that will be required under this new framework.
Yeah, which is interesting because we typically don't think about privacy and security first when it comes to the attributes of blockchain. And I think that those winds are shifting a bit there, because at some point, privacy and security is going to have to be addressed, right? I mean, there are privacy laws in the US and elsewhere. So how is that gap being, not widened, in other words?
Yeah, well, I think the first, blockchains were designed to be permissionless, public, and to give access to everyone. And that it was not designed by native architecture to provide privacy, right? And I think there's a big shift even from, there was a recent post by Vitalik Buterin, which is the founder and creator of Ethereum, where the next big thing for Ethereum is the privacy roadmap, to allow people to transact with full privacy, but at the same time guaranteeing this. And I think this shift has been moving over the last few months. It's something new. Obviously, if you are in a permission network where one participant controls everything, then you kind of don't require privacy. But if you want multiple parties, which is part of the existing financial market where multiple parties are trading, are exchanging assets, are depositing collateral, are effectively doing on-chain business, but then the privacy element will be strongly required. You don't want a bank A to see all transactions of a bank B, It's kind of prohibited, let's say, from a transactions perspective. So I think this element will be very key going forward.
Yeah, and John, expand upon the dual approach that ATV is taking as it relates to compliance for both U.S. and international investors, and how you're thinking about the regulatory framework.
Yeah, absolutely. I mean, I think that's the next big step for adoption is have a securities regulation roadmap and everyone understands it and how it works. Personally, I'm a recovering securities attorney, so I'll always be more for disclosure and transparency, and that's what we need, especially with these digital assets. I know I just got back from a conference in Hong Kong, and there's a lot of talk about what's going on in Hong Kong, Singapore, South Korea, but guess what? Everyone's waiting on the U.S. and what the SEC is going to do and the commodities are going to do. Fortunately, this administration is addressing that head on with some of the crypto task force and some of the other things that have been formed for all players, in the marketplace, not just regulators, but everyone, and get their feedback and do that. So I believe we're getting very close. Once we have, some consensus around securities regulation, then all worldwide people fall in line about how we treat these, tokenized securities, and we can all be on the same path together.
Yeah, well, as a law school student focused on privacy law and cybersecurity, these things are always coming up in my line of questioning. So I certainly can relate to you from that perspective. Marcos, you brought up an interesting point, how this is the next phase of the financial markets. Just as it was when we saw digitization and online electronic trading come into play here. Why is it the next phase? Is it because this is how liquidity will be sourced? Is this how capital is going to be formed? Why do you think this is the next phase?
I think there's the current financial market infrastructure has been set up in the early 80s and even before. You take SWIFT, has more than 50 years. And there's the intrinsic inefficiencies with this infrastructure, right? I was in New York last week, and there was this panel with Nadine Shakar from the TCC. So they have like billions of dollars or trillions of dollars of collateral assets, and you cannot move assets seamlessly currently on the existing markets. You were saying, oh, imagine, a hedge fund trading in Japan markets could port overnight from US, assets to use as a collateral in Japan markets and bring it back the next day. So currently, this is impossible. That will save the hundreds of billions of dollars of margin calls, collaterals, and the cost of capital. Imagine the savings of placing multiple collaterals in multiple venues without being able to move seamlessly in between them. So this is perceived already a huge improvement on the capital markets. And I think this is what people will see. We're talking about trillions of dollars of trading. The GTCC itself settles $13 trillion a day. Imagine if you can optimize 10, 20% of it in terms of collateral. It's an immense number. It's super huge. So I think that's what we will see in the coming years. Obviously, there's a long way to go for these existing markets to migrate to blockchain. But I think that we're at the very beginning of this transition and this shift on the infrastructure.
Yeah. And John, I would agree with you in terms of product versus regulation. I think the next catalyst is going to be when the U.S. is able to provide more clarity on regulatory framework, whether we pull aspects in from what we have existing as it relates to privacy law or existing, SEC regulations. But until we get that framework, that's what's going to make this scalable. You can introduce as many products as you want, but until you have that framework and understand how to operate within that framework, to me, that's the catalyst.
Absolutely. And what we've done with this product, you can be traded and purchased anywhere in the world. I mean, if it's a legal group, of course, we have all the usual KYC and anti-money laundering things in place. But if you're someone, for instance, in Latin America, Marcos is sitting in Latin America, but if you're in Argentina, for instance, you have a huge inflationary risk. And now, with this product, you could, invest with U.S. mortgage-backed securities and have a very, secure fixed income portfolio there. But absolutely true. You want to know how that's going to be treated, from a securities law perspective. If you're subject to that here or in the United States. So that has to be done.
All right. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you so much.
You got it.
Yeah.